This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Make or break why tomorrow's jobs report could determine whether the Federal Reserve does something later this month that it hasn't done in nearly a decade. The digital highway. Will big investments in technology help make your commute a whole lot easier? And too much risk? Why your portfolio may not be as diversified as you think. All that and more tonight on Nightly Business Report for Thursday, September 3rd. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off today, a day that saw a big market rally fade, and we'll have more on that in just a moment. But we begin tonight with the job market and tomorrow's employment report for August, which is being hailed as one of the most important in recent memory. Not just because it's a barometer for the health of the economy, not just because it lets us know how many people are working and whether wages are rising, but because it is the last piece of the economic data that the Federal Reserve will get before its next meeting later this month, the one that some think could mark the first interest rate hike in nearly a decade. A strong report could bolster the case to raise, a weak one to wait. And we'll get that number before the opening bell tomorrow. Hampton Pearson has more.
Heading into Friday's all-important jobs report, more signs of underlying strength in the overall economy. The trade deficit shrank in July to just under $42 billion, its lowest level in 5 months due to increased exports. And service sector companies expanded at a healthy pace last month due to robust consumer spending from job gains. On the flip side, forecasts for private sector job growth came in less than expected at 195,000, and weekly jobless claims increased by 12,000 to 282,000, above expectations but still consistent with a stronger jobs market. In recent years, August headline job numbers have come in below expectations, only to be revised upward in later months. So economists and market watchers are paying more attention than usual because it's the last piece of key economic data before the Fed meets in 2 weeks to consider raising interest rates for the first time in nearly a decade.
They can be put off easily, the Fed, if the numbers don't hit their mark. So it's 220,000 payroll jobs, pretty much has to be there. Unemployment rate has to come down a tenth from 5.3 to 5.2, and wages at least have to hold at 0.2% for the month, 2.1 year over year. If we don't get that constellation of data and the market, rallies, I wonder what the Fed's going to do.
But leading international economists say a fragile global economy and market volatility triggered by the downturn in China may keep the Fed on hold.
The main issue for the Fed is not whether it should have hiked. It should have hiked. Okay? The main issue is not whether the domestic economy warrants a hike. It does. Is do you really want to do this when the global economy is so fragile? If they hike in September, it will be the equivalent of what China did a few weeks ago with the currency. The right move, but at the wrong time. And that's why I think net, they'll wait.
More good news for workers late today. A national survey of small businesses found hiring increased in August, with wages for hard-to-fill jobs going up as well. For Nightly Business Report, I'm Hampton Pearson in Washington.
While the U.S. economy appears to be chugging right along, the same cannot be said for Europe. Today, the European Central Bank cut its growth and inflation forecasts for that region, blaming concerns over the global economy. Mario Draghi's downbeat tone is pretty much in line with prior comments that the European economic recovery has been disappointing.
The information available indicates a continued, though somewhat weaker, economic recovery and a slower increase in inflation rates compared with earlier expectations. More recently, renewed downside risks have emerged to the outlook for growth and inflation.
Many are interpreting these comments to mean that the ECB's €1 trillion stimulus program could be expanded. The risks Draghi referred to include a further fall in oil prices and a slowing Chinese economy, which of course is the world's second largest. China's stock market, which sparked much of the recent volatility across the globe, is closed today and tomorrow. This is as the country commemorates the 70th anniversary of the end of World War II. China is marking that occasion with a military parade in Tiananmen Square in what some say is an effort to divert attention away from its economic issues. Meantime, the White House is getting tough with China. In an exclusive interview with Steve Leisman, Treasury Secretary Jack Lew criticized that country over the way it handled its recent currency devaluation and emphasized the importance of China's economic relationship with the U.S.
If there's further devaluation of the yuan, will that give you concern that China is trying to depreciate its way out of its problems and do so in a way at the expense of the United States?
Look, I think that we have been very clear for a very long time with China. How they manage their exchange rate is a matter of great concern to us, and that they need to be willing to let market forces drive the value up, not just drive it down. That's a message I've delivered very clearly. I think at a moment when their economy is weakening as opposed to strengthening, it's easy to say the pressures are to go down, not up. But this is not a new conversation. This is a conversation that's been going on for some time. So we need to see a serious commitment to the kind of reform agenda that makes it clear that over time, their currency will go up as their economy is strengthening, and they need to be committed to the kinds of policies that will contribute to stronger economic growth.
The Republican presidential contender Donald Trump says what's going on with China's economic policies amount to the greatest theft in history.
I don't need to look to the political statements to focus on the importance of the U.S.-China economic relationship. It is an enormously important relationship. It's one where China needs to understand quite clearly that we expect for them to behave in a way that's consistent with agreements that they have made, where we expect them to behave in a way that meets a level of transparency, where it's credible that they're moving to keep commitments that they've made. And they have to understand, and I make this point to them quite clearly, that there's an economic and a political reality to things like exchange rates. And they need to understand that they signal their intentions by the actions they take and the way they announce them. And they have to be very clear that they're continuing to move in a positive direction, and we're going to hold them accountable.
Treasury Secretary Lew also spoke with Steve about the Iran deal, saying the U.S. will continue to implement sanctions until Iran complies with that agreement. Lew is scheduled to attend the G20 finance ministers meeting in Turkey this upcoming weekend. Meantime, on Wall Street, another big rally faded. The blue chip Dow index was up nearly 200 points early in the day on those comments from ECB President Mario Draghi. But volatility took over and the market just couldn't hold on to its gains. By the close, the Dow Jones Industrial Average rose just 23 points to 16,374. The Nasdaq slipped 16 points and the S&P 500 was up 2 points. The move lower in stocks followed the price of oil, which started the day much higher than where it ended at $46.75 a barrel. Well, the volatility in stock and bond markets are prompting some investors to take another look at their portfolios to determine whether they are diversified enough to protect against the big ups and downs. But according to our next guest, you're likely not as diversified as you think. Joining us is Ken Kamen. He is president at Mercadian Asset Management. Good to see you, Ken. Welcome to the program. You know, people put money in ETFs and bond funds and market funds all the time, thinking that that is achieving diversification for them. But you argue it is not. How so?
Well, it's not that it's not achieving diversification. It might not just be achieving the amount of diversification you think. So you look at something like the S&P 500, one of the big ones, maybe the spiders or whichever. The S&P 500, those ETFs are what they call cap-weighted, meaning that the largest companies take up the most bandwidth in that index. So when you actually look at that, 60 securities represent 51% of the S&P 500 index that most people buy. So another way of thinking about that is for every dollar you put into that, 51 cents of that is going for 60 stocks, and the other 49 cents are going to buy the other 440.
So if you want to increase your diversification, then what index do you think better reflects a diversification for a quote-unquote typical portfolio?
Well, if you want to get representation broadly in the S&P 500, you could buy something like an equally weighted S&P 500 index, ETF, excuse me, where it owns theoretically one share, of each of the 500 securities, so you get a more broader band. And I'm not saying one's better than the other.
Does this broader index smooth out the volatility?
Yes, and what it does is it gives you a bigger swath of the economy that you're participating in. You're not just participating in the largest 60 stocks. So when you look back since the market took off in the beginning of the bull market in March of 2009, you actually see that the equal weighted one has done better than the one that everyone buys. Now, that's not necessarily, as a recommendation, as much as, we're seeing so much swings in the market, and everyone's concerned about these big, up 1,000, down 500, up 600.
Right.
What people need to realize is that in many ways, these indexes are becoming momentum driven. When so much money is going into such a narrow swath of companies, the way ETFs are constructed,
it's creating the volatility.
It's creating, as it goes up, the ETF makers have to buy more of those big stocks. And when it goes down, they have to sell more. So it's a momentum play people don't realize.
What about the broader market and the volatility that we have seen that's linked to China, perhaps not linked to this momentum play? Do you view that as slowing down or smoothing out a little bit, or do you think we have more rough seas ahead?
Well, I certainly think volatility is here to stay. And I think investors need to get used to much wider swings in the market. When now markets are pretty much dominated by computers and these very easy to trade risk-on, risk-off trades. Things people have to realize is that in the old days, mutual funds were priced at the end of every day. So you got that day's price.
Right.
They weren't moving markets during the middle of the day, whereas ETFs trade like risk-on, risk-off, and you're seeing these huge trades.
Yeah, you need a little Dramamine.
You do.
Ken, thank you very much. Ken Kamen, President at Mercadian Asset Management. Well, ahead of tomorrow's jobs report, more than 8.5 million workers are likely wondering whether they'll be impacted by a recent federal ruling. The National Labor Relations Board last week broadened the definition of employer while redefining what an employer is. May not seem to you like a big deal. Kate Rogers explains that it could have huge implications for franchise operators.
Do we add another layer of overhead? Do we add more consultants? Do we hire more attorneys? And what do we do to make sure that we're in compliance?
Franchisees across the country are beginning to absorb what last week's ruling from the National Labor Relations Board might mean for their future. Under the broadened definition of employer, franchise locations could be considered joint employers alongside their corporate parent, in an industry that has long separated the two. Now the corporate parent may also be responsible for liabilities and violations at franchise locations. Mara Fortin, owner of 7 franchise locations of the bakery Nothing Bundt Cakes across California, fears it will take away her ability to run her business independently. The former lawyer got into the industry seeking her own piece of the American dream.
I got into this to be my own business owner and to have a say in how my business ran with the support of a brand. And what's happening with the NLRB is it really takes the power away from me to run my own business.
Among her concerns are higher costs from her corporate parents and more oversight to remain compliant under potential joint employer policies. More broadly, the industry's largest trade group says the move may, quote, create havoc within the fast-growing segment of the economy, causing fewer stores to open and holding corporations accountable for actions and violations at franchise locations. According to the International Franchise Association, the franchising industry was projected to grow about 1.5% in 2015 to more than 780,000 locations nationwide. Franchising employs 8.5 million workers across the country, and this decision, they say, could stifle that projected growth. But wage advocates say the NLRB's decision is simply a reaffirmation of decades-old labor law.
This notion of a joint employer has been around for a long time, at least since 1938. So Browning-Ferris really just clarified that franchisors and franchisees may well be joint employers and have a duty then to bargain with their employees.
It remains to be seen how this decision may impact a separate case the Labor Board is weighing against McDonald's over labor violations expected to resume this fall. Experts say it could very well set a precedent. For Nightly Business Report, I'm Kate Rogers.
And to read more about how that NLRB ruling might impact franchise operators, head to our website, nbr.com. Still ahead, how Disney plans to develop a new generation of Star Wars fans and a new generation of potential prophets. Some good news if you're planning on taking a road trip this weekend. Gas prices are falling. This holiday weekend, the cost to fill up will be the cheapest since 2004. According to AAA, the national average is currently $2.44 a gallon, nearly $1 below where it was a year ago. And that translates into big savings. All in, consumers will save a total of about $1 billion on gasoline this holiday weekend alone. And if you do plan to drive this holiday weekend, you will be very aware of the poor state of our nation's roads and all the traffic that goes right along with it. But amid the hand-wringing about our aging infrastructure, some states are building a digital infrastructure with the aim of improving your commute. Mary Thompson reports from Woodbridge, New Jersey.
More than 2 million cars a day travel the New Jersey Turnpike and Garden State Parkway, where accidents and weather often disrupt commutes the state wants to disrupt and speed up with the help of technology.
We're trying to improve our visibility of the roadway, and we're improving that visibility for traffic management professionals.
Barry Pelletieri is the Chief Information Officer of the New Jersey Turnpike. At its Traffic Management and Technology Center in Woodbridge, a massive video screen reflects information sent from sensors embedded along the road's 2,600 lane miles and views from cameras perched along the way.
The more data that we can bring into this center and then analyze, the more pertinent information we can give to our professionals who know the roadway that then inform all of our motorists.
With Americans spending an average of 40 hours or a work week's worth of time stuck in traffic, New Jersey looks to ease commutes, sending information to dynamic signs warning drivers of accidents and slowdowns and providing estimated travel times. This isn't unusual, but in the future, IBM's Catherine Fraze, who worked with New Jersey on the system, says the information will be used in other ways.
You go from analytics that tell you what happened to starting to predict what might happen to being able to prescribe what would be the best thing to do.
That means someday drivers can be directed to less congested roads, or barriers could be moved and lanes shifted to accommodate heavier traffic flows, while the sensors and weather data will be analyzed to direct travelers to the best roads in bad weather.
We're using digital technology to thermal map the roadway, and what that tells us is it allows us to determine the propensity for different parts of the roadway to freeze earlier.
While the current goal of this digital infrastructure is to get better information to the signs like the one you see behind me, the ultimate goal is to get that information directly to the cars and their drivers. A shift requiring new technology in many cars and continued investments of technology in the roads they drive on. In Woodbridge, New Jersey, I'm Mary Thompson for Nightly Business Report.
A food deal is where we begin tonight's market focus. General Mills is selling some of its vegetable brands, including Green Giant, to B&G Foods for nearly $1 billion. General Mills, which owns Cheerios and Yoplait, said the deal will allow it to focus on its other brands. Shares of B&G Foods popped more than 11% to $34. General Mills was more than 1% higher to $57.61. Land's End saw its sales continue to slip in its most recent quarter. The company's spring and summer apparel didn't perform well with customers, but the declines in profit and revenue were not as steep as some analysts had expected, and that sent the shares 5% higher to $27.45. A big miss from Joy Global. The mining equipment company reported earnings and revenue that came in below estimates as weak demand for commodities weighed on its business. The company also cut its guidance for the full year. Shares tumbled more than 14% to $18.90. And Verizon and Royal Caribbean are raising their dividends. Verizon's new payout of 56.5 cents per share will be payable in November to shareholders on record as of October 9th. Royal Caribbean increased its dividend to about 37 cents a share, which will be payable to shareholders in October who are on record as of September 18th. Verizon shares were slightly higher to $45.72. Royal Caribbean rose a fraction to $89.29. Disney's big investment in Star Wars is entering a new phase. This one is a marketing push like few have ever seen before, and it starts tomorrow, months before the first film is scheduled to be released. And Julia Borston tells us it's not just Disney that's expected to profit from what's being called Force Friday.
Force Friday is an unprecedented global merchandise campaign with hundreds of new Star Wars products hitting stores. Disney and retailers are pulling out all the stops. The Disney Store, Toys R Us, and Walmart are opening their doors at stores around the world at 12:01 Friday morning. Plus, online, those retailers and Amazon are making a promotional push for exclusive toys and deals. It's the start of a 3.5-month-long rollout of products, which licensing expert Marty Brockstein says expands Disney's merchandise potential.
4 to 6 weeks maybe in front of the film is when the second wave of merchandise is going to start to appear. So this way everybody gets a couple of different bites of the apple.
That's not only great for Disney, but also Hasbro, which has the majority of the toy licenses, plus Lego and retailers, particularly Toys R Us.
Force Friday could meaningfully accelerate Disney's consumer products division's growth, says JP Morgan analyst Alexio Quadrani. She projects about $500 million in incremental revenue and $200 million in incremental profits in Disney's fiscal 2016.
1, 2, 3.
And to maximize Star Wars potential, Disney's turning to the power of YouTube and the popularity of unboxing videos to lure a new generation of Star Wars fans. It's giving its Maker Studios stars with huge YouTube followings movie merchandise to open in a live stream on Star Wars YouTube channel. Disney's hosting events featuring those Maker stars in 15 cities around the world in an 18-hour live streaming lead-up to the toys going on sale.
I think Disney bringing in Maker talent was very smart because Star Wars is very much community-based and they understand that. And a lot of the people who have been very excited to play with the toys and unbox the toys and do what they do anyway are just being amplified. And to be a part of that is really showing that Disney, Star Wars, and Maker really understand the community connection, especially when it comes to Star Wars, which is more than a brand to some of us, it's a lifestyle.
If this strategy works, Disney will turn the YouTube generation into Star Wars fans, while introducing older Star Wars fans to Maker videos. The risk? All this promotion overdoes it. But at this point, analysts are optimistic. For Nightly Business Report, I'm Julia Borston at Lucasfilm in San Francisco.
All right, coming up, student housing at college used to mean shared bathrooms and cinder block walls. But that was then. Wait till you see what's happening now. To housing now, where the average rate on the 30-year fixed-rate mortgage rose slightly last week. Freddie Mac says the rate increased to 3.89% from 3.84% the prior week. Mortgage rates tend to track the yield on the 10-year Treasury note, which has been very volatile lately, along, of course, with the market. It is one of the hottest real estate plays today, just in time for back to school. It's student housing. But here's the twist. As the market gets more competitive, developers are tricking out the properties, luxury living on a student budget. Diana Olick shows us how it works from Athens, Georgia.
It may look like happy hour at the Four Seasons, but it's just a weekday afternoon at the University of Georgia, off-campus housing.
My parents call this Shangri-La.
The Standard, developed by Athens-based Landmark Properties, is aptly named because apparently this is what students today demand. The resort-style pool, fitness center, racquetball, sauna, game room, private study lounges, and granite-laden apartment suites that would balk at the very idea of cinder block walls. Developers say the most expensive suites actually lease up the fastest.
We're going to be catering more to the probably 10% or so of our unit types, making them super premium, offering larger square footage, more amenities for those residents, maybe 2-story rooftop townhomes with private rooftop patios.
How do students pay for all this? Prices actually aren't much higher than on campus, where costs have been soaring. Developers charge by the bed, not the unit, and they target big public schools which have lower tuitions.
And then there is the foreign factor. As millennials age out of their college years, foreign student enrollment is climbing and more than making up the demand. Foreign students tend to favor all these amenities.
Landmark is taking its standard brand across the nation, growing footprint and profit. They sold the Athens, Georgia property to American Campus Communities, the largest student housing REIT. This as another REIT, EDR, put a waterfall into its new building down the street.
Now we're starting to see institutional quality developers and investors, and so it's getting a little bit more competitive to go after the market share.
Coleman says demand is strong and parents' pockets are deeper than you might think.
If it's $1,000 more a semester, say, it I think is worth it compared to the competition is going to be older, dilapidated, in many cases, in many markets, unsafe product. It's not sprinklered, it's not up to code.
Of course, the thing about the Shangri-La is, what's going to happen when you get out in the real world and y'all can't afford all this?
That's what my dad's been telling me when I moved in. It's going to be a downgrade after college for sure. So.
It quickly turns to paradise lost. For Nightly Business Report, I'm Diana Olick in Athens, Georgia.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Have a great evening. See you tomorrow.